Good morning, everybody. Mike Nelson, Efficient Lending Incorporated. I certainly hope everybody is doing well. And, COVID is something that we're all dealing with. I know it's tough times. I haven't done a weekly agent and market update in a while, so I felt I really wanted to get back into this kind of rhythm every Tuesday morning, talking about what happened past week and possibly what's going to come in the future. So, the last 2 months have been a really interesting time in mortgage lending, and I thought it might be useful just to kind of share a couple insights and not surprises, but things that I learned in the last 2 months. And also I want to talk a little bit about what it might look like in the future. Of course, nobody knows. But I think, there's a collective good between agents and lenders and consumers, and we can all kind of get a feel for, what's going to happen based on our experiences. So first thing I want to talk about is this is a chart of returns, yields for mortgage-backed securities, which trigger interest rates. I'm not going to get into this in a lot of detail. But if you look back at the arrow on the left, that is when, early March, mid-March, where all the modeling in Europe was happening that has since proven to be inaccurate as far as, we're not going to see 2.2 million deaths in the United States. And you see those huge market fluctuations for that week or so period. And I will tell you, when we were living that and going through it, I'm watching the financial returns on my desk. I'm talking to agents and borrowers, and they're saying, what do we do? How do we deal with this? And I got to tell you, it was crazy. At that point, the Fed, I think in 1 week, they bought $187 billion in mortgage-backed securities to try to stabilize that. I'll give you a little, a comparison. Today, where it's stable, the Fed, I think, is going to buy around $4.5–5 billion in securities. So, one of the insights that we've had is that the market can go through an unprecedented time in history. We've never seen this before. But look how fast it started to stabilize. Markets like to be predictable. And you can see now where it's stable that we're trading in a really narrow, small range. And that is really, I think, good. And I was saying back in early March, when we start to see these ranges shrink, that's when we're going to start to see maybe some improvements happen. So I can't tell you if it's improving now or not, but I can share with you that's one of the indicators that I really thought I wanted to see. The other thing that was really interesting, forbearance. I'm not going to get into forbearance right now. This video will be way too long if I do, but just understand there's almost 8% of the mortgages in the United States right now are in forbearance. And forbearance is a good tool if it's last ditch. You're going to lose your home tomorrow. Put that mortgage in forbearance, I get it. But if you're putting in your mortgage into forbearance, to try and get 3, 4, whatever months no mortgage payments, extreme caution. That is gonna be with you for a long time and potentially put your home at risk. So forbearance was really easy. It came out really quick, and I was a little surprised that we could go to that level that fast. The other thing that's really interesting, people, purchase and refinance deals are getting done, and they're getting done even in the biggest period of instability as far as MBS goes. I was having to read a lot more. Yes, a lot more stress, tension, pressure doing this job. A lot of confusion. But I will tell you, the markets really handled it much better than I thought they would. And that's a good sign. I mean, let's face it. Right now, we've got let's call it 18 to 22% unemployment. 20s in the neighborhood of 20 million people are unemployed. Chairman Powell came out, I think, yesterday and said that 40% of Americans who make $40,000 households, 40,000 or less, have lost their jobs. Guys, that's got to change. That is huge suffering, but the markets are dealing with it, and that we have to have that foundation. So one of the insights that I have is I think that's positive. I think it's really good, and candidly, I was a little bit surprised by it. How well it handled, how well the communication was between processors and borrowers and agents and lenders. All right, trending in the future. Look, and my goal here is not to have. There's so much energy. There's so much political tension right now between, lockdowns, not lockdowns, opening comments. I'm trying to basically just state some pure facts here. There's no bias to this, but as it pertains to mortgage, you get a mortgage based on 3 things: assets, income, and credit. And you cannot be unemployed and have all three of those. You might have good credit for a while, but it won't last. You certainly can't have income, and you can't acquire assets without a job. So the employment's the kind of common thread, and employment is the foundation to any recovery. So until we can deal with that, this notion that we have got to get people working, and it can't be 20 million people or 4 million people a week claiming unemployment. We have to get back to employment if we want a vibrant real estate market in the United States. So that's going to be a part of it, whatever that looks like, and it's got to be quick. We can't go months with people not working. It's just the real estate market won't function. Real estate will be a key driver to recovery. Look, it's stable. Real estate stabilizes markets. It's central to wealth creation. You got to have wealth creation to have good employment. You got to have wealth creation for vibrant jobs market. Just the GDP alone associated with. So what does that mean? Once employment starts coming back, lenders, investors, once the risk appetite changes, they're going to want to lend more money. They're going to want to invest. They're going to get a return. And as that happens, you're going to see real estate start to drive. I'm going to share some numbers that came out today in next week's update, and I can tell you there's some signs that real estate can be very healthy going forward, and I think that's important. Look, I'm just going to stop on this a second. Government debt has to be repaid. I think I heard Powell saying we may need to have a third round of relief. Guys, it's finite. You just think about yourself. You have credit cards. There's a maximum limit. It's the same for the government. The employment is the solution to not having more relief programs. So we got to reopen markets. We got to do it quickly. We have to do it safely. We have to do it with wisdom. COVID's very serious. But until we get, this notion of employment coming back and less relief from the government, that's going to be the key driver as it relates to real estate. The other thing is the financial markets in the United States are resilient. History proves this through world wars, Great Depressions, Great Recessions. We got a super strong financial market with really good people working in them. And look, once the financial markets have incentive to take less risk and make more return, they'll come back with a flourish. We've got the products. We've got the tools to lend effectively in real estate. I think we've proven that, certainly after the financial crashes, but certainly in the last couple months. So anyway, folks, that is kind of my update for this week. Listen, I love to chat with people, love to continue the dialogue. So chat, email, message me anytime. Oops, I went in the wrong direction. Let's go. Chat, email me anytime. Oops, let me click. I'll get to the right one. And there's my contact information. Sorry about that. And I hope to chat with you soon. Have a wonderful finish to the week. Thanks again.